rental rates are increasing because there's so much more money in the marketplace. 2 to 3% was sort of the traditional rental growth that operators were comfortable projecting.
Hello, everybody, and welcome to Get Diversified. We have another exciting episode here. My name is Jacqueline Landry, and we have a very special guest, Michael Margarella. He's also Italian, like I am. So, wanted to introduce Michael to the show. He is a principal of Next Play Investments. So, welcome, Michael, to the show.
Thank you. Super excited to be here and chat real estate.
Fantastic. So, why don't you give the audience a little bit background about Next Play Investments and what your role is as a principal?
Sure. So, Next Play Investments is a private equity firm that focuses on purchasing commercial real estate. And we mainly focus on purchasing multifamily and self storage in the Midwest. And excited to dive into those topics today.
Fantastic. Let's dive right into why you think multifamily and self storage are recession resistant. And I want you to focus on the resistant part and explain why you preface it that way.
Yeah, for sure. So I think that's an important point of emphasis there because there's nothing that's recession proof. But with that being said, and especially given some of the economic turbulence in recent years, it's important to be cognizant of asset classes that perform better, or at least better than most during recessionary times. So if the last few recessions have taught us anything, it's that multifamily and self storage have come out of those as the better performing commercial real estate asset classes. So that's part of the reason that drove our initial interest in the asset classes. And I think some of those reasons include something that I think we're seeing now as it pertains to interest rates. So as interest rates are increasing and the prospect of home buying is becoming more and more difficult for consumers to achieve, that's putting more renters into the multifamily market. So that's causing occupancy increases, that's causing rental rate increases, which are all good things for multifamily operators. Also, during a recession, folks tend to downsize. Statistics show that divorce and displacement tend to increase as well. So those are all drivers for multifamily occupancy and also for self-storage. So in the self-storage world, basically anytime people are moving around, whether that's from state to state or downsizing, that's usually when people store most personal property, and that's usually when occupancy increases the most. So for all those reasons, we're very bullish on multifamily and self-storage, even during recessionary times.
That's really good. Now, do you think that when multifamily's up, self storage is up? And when multifamily's down, self storage is down as well? Like, do you think that they go hand in hand with being on the ups or on the downs?
I think they do go hand in hand to some extent. Like I said, if you look at some of the statistics on the past few recessions, you're going to see both multifamily and self storage somewhere in that 1, 2, or 3 range as far as performing commercial real estate asset classes. So I do think there's a lot of commonalities there. And like I said, basically when people are moving, whether it's because of downsizing or two households becoming one, or when home buying rates are increasing, those are all things that are going to lead people more towards that multifamily rental market and also more towards that self storage unit rental market. So they really go hand in hand to some extent.
Fantastic. So, what you're telling me is the majority of the people that are renting these self storage units are tenants versus homeowners.
For the most part, yes. Yeah. Most of the clientele for self storage units are renters. Now, of course, there's some folks who treat their storage unit as an extension of their home that they own. So basically, a larger garage, if you will, to store their toys and things of that nature. And of course, we're coming off a time where a whole lot of money was printed and a whole lot of people were buying toys during COVID, whether that was RVs, trailers, boats, and folks that do own houses in HOAs, let's say, don't really have places to store those. So we see a whole lot of those folks coming into the self storage world as well in the last few years. And I think that whole printing money concept raises another interesting tidbit about both multifamily and self storage, which is, it's my opinion, both of those asset classes are also inflation resistant. So again, I mean, along the same lines of recession resistant, there's nothing that's inflation proof, but with more and more money being printed, what we've seen, and again, for some of the reasons that we've spoken about earlier here today, rental rates are increasing because there's so much more money in the marketplace. And so for multifamily and self storage operators, that inflation, while some expenses are, of course, increasing, is helping those operators keep pace just because rental rates are increasing so much in the past couple of years.
So, what do you think for some of those markets where the rents are not increasing as much as they thought they would or that they projected? did in their business plan.
Yeah, that's certainly an issue, especially in the multifamily space in some of the quote unquote markets, COVID. So we saw a whole lot of markets with double digit rental growth in the early 2020s. And I think it's certainly a dangerous proposition to assume that tremendous rent growth when you're going into a project. I think being conservative on the rent growth front is super important. So 2 to 3% was sort of the traditional rental growth that operators were comfortable projecting. And I think a lot of people are going to get in trouble if they were assuming that 10 to 15% rent growth, because as you alluded to, that's starting to level out a little bit. I do think some of those statistics, we have to look just a little deeper into them, because while the rental growth has certainly slowed there, it's not as if rental rates are falling, at least in most markets. They're just not growing at 10, 15% clips anymore. They're more at that 2 to 3% clip. So I think operators will mostly be okay if they were conservative in their projections, but I think there's certainly some folks who could get in trouble there. What the REITs generally do is every quarter, every 3 to 6 months or so, they're going to increase those rates. Somebody moves into a unit for $30, and then 6 months later, you're increasing their rent to $50 per month.
Jacqueline and Melvin, thank you so much for taking time out of your busy day to listen to this episode of Get Diversified. Please make sure to subscribe to our podcast so you don't miss out on future episodes. Finally, stop by our website and follow us on social media. Ciao for now. Make it a great day, and we'll see you next time. And remember, get diversified.